All right. Good morning. Good morning, everybody. Um, we see this same collection of data come around again and again. We get the 10-year auction, and then the same day or into that evening, we get Japan and its rate decision. Now, it's very unlikely that Japan is going to raise rates. It's also very unlikely that they're going to hint or propose any hike anytime soon. That's what we would expect because it would keep things stable. It wouldn't generate volatility or freak anybody out. And so that's sort of the base case argument. And if that is how it all plays out, it's likely that we'll continue to grind higher or will at least hold steady and digest. But if any of that is off the mark, if they do a surprise rate hike, that'll certainly tank the markets. If they hint or propose a future hike, that might cause some volatility while it gets digested and they kind of figure out what they want to do with that going forward. So while that one can cause some issues, the big one would be if they just come out with a surprise rate hike. It's not in their best interest to poke the bear. So I don't see why they would raise rates, but that's the big issue for tonight, and it is going to be in the overnight hours. So before the market closes today, really take a look at what you're holding. The phrase that I always grew up with is, know what you own. Whether you're beta weighing your portfolio or you're just individually measuring each trade that you're holding, have a really good idea about the impact to your portfolio if the S&P was to drop, say, 3%, 3.5% overnight. There's a reason that we have lock limits on the futures, right? And I'm not proposing that we're going to see lock limits triggered, but if you're new to trading and you haven't seen the futures lock limit down after a 7% move, well, it has happened before and it will happen again eventually. That's why we have those lock limits in place. So just know what you own. I was expecting a little bit of a rug pull yesterday, and the market breadth was just nasty. We didn't have the weighted AD, we didn't have the ticks, the cumulative ticks. We had a really big divergence between the advancing and declining issues in the S&P and the advancing and declining issues in the NASDAQ. And yet we just kept going higher, higher. We didn't give it back until the very end of the day. And even then, we still kept most of what we took. So while I kept waiting for the rug pull, we didn't get it, which is great, right? I mean, that's awesome. But with all of this big data on the table, it wouldn't surprise me at all if we hold this spot and we go sideways. We already had a list of things that we knew was on the table today, like the 10-year, but we also have Trump in Davos, right? He's going to do it virtually. He's going to attend at a prearranged time. So he's not going there, but he will be speaking there. And that's going to be today at 11 o'clock. So kind of keep that on your radar. We have him at 11 and then auctions at 1. And it just, you got to put it on the table. We also have jobs data today. Remember, the jobs data is the second part of the mandate of the Fed. And they had already turned their attention away from inflation because, well, they were done with that, right? They had already assumed or decided that they had slain the beast of inflation, and now they just want to focus on job numbers. So anytime we get job numbers, you want to pay particular attention to it because that's what the market is focused on. We got the NASDAQ down 0.5%, small caps right behind it. then Japan, the S&P. The Dow is just poking above zero. So it really looks like the market's just digesting, holding, waiting. You can see we got some job numbers here, 8:30. And someone much smarter than me was paying close attention to this hiring freeze that Trump put into place when it comes to government hiring. And when there was a little bit of a look back to this, unemployment has been weak for over a year. The only entity out there that has been consistently hiring is the government. So if you put a hiring freeze on in the one group that's been doing all of the carrying on the job numbers for the last year, it may not hit this month with these numbers, but I would expect that we're going to see the job numbers start getting worse and worse from here unless the private sector picks up the slack. So, you know, we've just been skating along with these job numbers because of the government and its continued hiring practices. Well, those days are done. So we got to be mindful of the numbers we're going to be getting. And then, of course, keep in mind, you know, there's the headline numbers and then there's the revisions that they like to sneak in there after the fact, right? And that's not just, you know, from one administration, it's from every administration does those shenanigans. All right, so we're going to get a lot of jobs data this morning in about 53 minutes. Going to get some gas data. That's every Thursday, right? We get crude on Wednesday, gas on Thursday. Manufacturing data. Then we've got Davos, some auctions at 11:30, and then the 10-year auction at 1 o'clock. Then Japan overnight. And we'll be back in to do it again tomorrow. Starting to see the 10-year push up again this morning. And it's just a little push at this point. Want to see where it goes from here, though. Keep your eye on that thing. Make sure it doesn't start to run away. All right, so we've been focused on these lower highs and lower lows, and now flipping everything over. And we broke that key lower high. Then we broke this lower high, and we're digesting here. Now, you know, typical consistent market moves, it's a two-way street. We get pullbacks, right? It's what we're supposed to do. It's normal. We've got to try to anticipate what sort of pullback we're going to get here. As long as it remains above this low way down here, then any pullback we get is going to be, quote, okay. But you really got to kind of digest that. If you're looking at a normal market that had been trending to the downside and it starts working its way back up, you don't want it to come down a long ways and then say, well, at least it stayed above that high. That's not a good market structure. So if we had done something like measure the depth of each of these legs, measured the pullback on each one of those legs, we could get some kind of normalized idea of how deep this pullback could be. But that doesn't really factor over, right? That's not how they lay it out in textbooks if you want to anticipate this move. What we can do is we can measure from the current run. Now, this one candle was just one day pullback. It wasn't enough to make this a lower high. And at this point, we've only got this tiny little candle, and that alone doesn't give us license to make this a new higher high. But if we're going to run on the assumption that we are about to pull back and we're going to get a leg down, the way that I would do it is just measure this entire run and mark the halfback. Just like measuring this entire run and marking the halfback was our line in the sand of how far we would have to go to the upside to begin reclaiming this. We had to get higher than that half, and we did. All good. Well, use the same thing in the other direction. If this is what we've got right now, and we want to see it continue, then it needs to hold higher than that half. That's more than I would like to see it drop to the downside, but that at least fits everything that we could get out of a textbook when it comes to the strength of a market or whether or not it's still healthy. We've made a leg. We need to keep at least half of it. There's some solid numbers in here that we can apply as well, like 60.50 to big options level, 6,000 to another big options level, 6111 cog line, 6092, 6032, 6011. So all of those would be structures that we could anticipate working with. But 5972 is a line in the sand that I wouldn't want to see crossed. And really, just to, not even worry about the tiny little semantics of it all, let's just stay above 6,000. We get underneath that, I think it'll start to get worse, right? And that takes us back to like the options levels that would be in place that are supposed to be like guardrails around price in the first place. Dealer hedging dynamics and all of that good stuff. The main takeaway, though, is don't be surprised if we get a pullback, and that a pullback wouldn't be a bearish scenario, right? It would just be a healthy scenario. We need to pull back at some point. Otherwise, we'll start to get outstretched, and that'll start freaking people out, and volatility will rise, and VC funds will start to duck out, and it just goes downhill from there. So we still have all the options levels, call wall, put wall, volatility trigger, zero gamma, all within our own week's range, right? Because we've got the low of the week here, high of the week. These levels are within our own week's range. We got the 10-day and the 20-day all the way down in the 60-30, 60-17 range. 3-week moving average, 60-50 area. Those are all at least 60 points away. They're not going to be helpful, right? The only thing we have even remotely close to us right now is the call wall. And now that we're done with OPEX, we want to continue to keep our eye on the options structure to see where that call wall goes next. If they don't roll it up, it's likely that we're going to come down away from it. So yesterday we had an MDP that counts for today. Today's pivot point opened higher than yesterday. That's considered bullish. Price opened above today's pivot point. That's also considered bullish. And today's channel is significantly more narrow than yesterday's channel. A narrow channel implies that if we do break out, it can grow legs and it can really run. Now, this isn't the most narrow a channel could be. It can be so narrow you only see a purple line. That's how narrow it could be. So it's not that narrow, but it's certainly more narrow than this one. And keep in mind, these channels don't make price break out or make price go sideways. They're just giving us some perspective on if we were to attempt a breakout today, how likely is it that that breakout grows legs and we continue to run. A narrow channel says if we break out, it's more likely to just keep right on running. Now, in the Spot Gamma's founders notes, they have something that they focus on called the zero gamma or the gamma level. And we don't have the AM founders note yet, but when we get it, we want to see what that zero gamma, and what is it called? The Spot Gamma's gamma index, as if they don't use the word gamma enough. Now that gamma index goes from a -4 to a +4. That's the boundaries of distance that it works with. So if it's at its most extreme to the upside, it can't go any higher than a +4. And if it's at its most extreme to the downside, it can't go lower than a -4. If we're in the positive gamma environment and we break out to the upside, the dealers would sell into that breakout because they're trying to remain delta neutral, and that's what they have to do. If we break down and we're in a positive gamma environment, they'll buy into that selling, right? They'll buy into that weakness. So in a positive gamma environment, it's why we don't get those big, long, crazy runs up or down, right? Those big breakout days. Because as we're trying to break down, dealers would be in there buying it and stopping it from really breaking down too far. And we don't really break out and run too far in that environment, because as we're breaking out trying to run higher, they'd be selling into it. Low volatility, and volatility is another word for movement. So smaller movement days when we're in a positive gamma environment. That shouldn't be a surprise, right? When you know that we've had a good, strong, clean, trending market, we get nice small candles in a uniform way, and we just keep going higher and higher and higher. That's what those small candle days are implying. Positive gamma environment, we're just running. It's when we get into a negative gamma environment where we start to get these really big candles. Because in the negative gamma environment, when we break down, dealers are selling into the selling, and then we just fall really far really fast. Or they buy into the buying and we run up really fast. So you want to look every day at what the Spot Gamma's gamma index is and check, first of all, are we in a positive gamma or are we in a negative gamma? Because that'll give you some clues on if we break out today and we begin to fall, are the dealers going to be selling into it or buying into it? It's much like these narrow channels that we were just talking about. With that in mind, consider how big yesterday's range is. That's what we would have to break out of. And we're nowhere near that on either side. So while this narrower channel says if we break out, we could really run, we would have to get all the way back up here to the high and then break out and then try to apply that logic of the channel. Or we would have to fall all the way down here and then break down and then apply that logic of the channel. So the likelihood that we even break down today is much smaller than our opportunity of breaking down yesterday. We can still do it. I never want to say that price can't do something. There's also the distance from this weekly pivot point. We're not at extremes yet, but we are a long ways from that weekly pivot. Now, to the downside, we can go a lot farther away from this weekly pivot than we can when it's from the upside. How far is too far? I've tried to quantify this every way that I have imagined doing it, and so far, I haven't had a good way to normalize how far is too far. More than 4%, I start to get concerned. I can tell you that. But even when we get to 4% to the upside, it still doesn't mean that we're going to, turn around and begin running back towards the weekly pivot. But that is where I start to get concerned about topping out and really struggling to get any further. This distance from the weekly pivot is not meant to imply that it owes us some sort of breakdown or reversal, or that we've got to go back the other way. The analogy that I like to use is a runner at Pikes Peak, right, in Colorado. So the higher you get, the harder it is to breathe, the steeper the road. So imagine someone's running there, and about every quarter of a mile, you stack another 25 pounds on their back. They run higher, and then you stack another 25. You're not stopping them from running. You're definitely making their run a lot harder. That's the distance from this weekly pivot. The farther we get away from it, it's not like we're going to hit some barrier that says, well, you've gone far enough, you can't go any higher. That's it. Turn around and go back. But it is making it more and more difficult for price to continue moving farther and farther away the farther away we get. So hopefully that analogy kind of cleans things up a little bit, or helps you understand why we focus on that. That move yesterday ended with a lot of volume up there. We have the point of control now overhead. 6130 is the point of control. So we ran up into a ceiling and a significant amount of liquidity. And now we've got this artificial cap over our head that has to be resolved if we're going to continue to go to the upside this week. It's not in perfect alignment with that FOMC week from December 18 from back here. It's not perfectly lined up, but it's pretty darn close. So, if we think of these levels as a zone anyways, then that zone is still intact and it's strong. We weren't able to get through there yesterday, and in fact, we reinforced it with the amount of liquidity that we hit yesterday afternoon. Ten-day, 30-minute volume profile and TPO, they're still not in agreement. Still looking to see this TPO move up and match the volume profile with the point of control, but we don't have it yet. And there's no pattern or shape here in the profile. This is just a big, nasty mess. That may be obvious, right? When you're looking at it and saying, yeah, this is disgusting. There's nothing here. But that's the point, though. If there's nothing there, then just acknowledge that there's nothing there. I've seen so many people struggle to analyze this and try to get something out of it as if it owes us something. It doesn't. If it's a good pattern and there's something worth reading, it'll be really helpful. But when there's not, don't even stress on it. Just move on, because there's nothing there. We're still expecting that point of control to move, and that's the best that we can expect at this point. We have a new VPOC from yesterday. So if we make that break to the upside, 61.24 is yesterday's point of control. So we're starting to stack it up a little bit. We have a really nice classic profile on the TPO this morning, but the volume profile is really developing a double distribution at this point. Kind of tangled. Want to see it clean up a little bit. I don't know that we're going to see that, or if we're going to end up putting in another one down here. if we drop down and begin digesting this lower structure. $60.82 to the downside, 61.24, and then 61.37. We're still fighting with getting back inside this week's range. We're not there yet. The statistics say that we should close inside this box at the end of the week. But the end of the week is still a long ways off at this point. We're still 2% above the 10-week. That's a really good start. Nothing wrong here. We're not overbought. We're not overextended. We haven't moved too far too fast, and it doesn't owe us any pullback on the higher time frame. This is just a really good spot to be. Now on the daily, we did get a little extended, got close to that 2%. That's 2% away from the 10-day moving average. But we've already started to come back again. And while these don't look much like waves, that's really what you want to think of them as. So we already topped out and we're starting the wave back. That doesn't have to be as scary as it sounds. We're not owed a move all the way back to the 10-day, just a move in the direction of the 10-day. There's been plenty of cycles where we don't get back to zero, or that if we do get back to the 10-day, that we just bounce off of it and move higher again. So, best case scenario, we digest this high, just going sideways, correcting in time rather than correcting in price. We give the 10 time to catch up with us, and then we move higher from there. That would give us more structure to challenge this all-time high. If we were to try running towards that all-time high, the way we did it back here, with one straight shot and a big move, sure, we broke the previous high and we set a new high, but then we dumped right back down, and the dump was kind of violent. So it'd be better if we can consolidate here, almost like what Adam Grimes calls a pre-consolidation breakout. If the bigger breakout is all-time high and we stay here and consolidate and digest before the breakout, then we can make this entire leg to the upside. That's 65. Let's just round down and say 65.50. Now, we're not talking about in a single day, right? Or even in a single month. It could take, say, all the way through the March contract and into the next contract to make that run. But it would be really healthy to do that digestion first before we attempt that run. All right, so we got Bitcoin down, airlines finally down a little bit, semiconductors, chips, China, precious metals, bonds, software, technology, communications. None of that is good. And to the upside, we have the VIX. That's it. It's the only thing we got up this morning, more than 0.5%. All right, now when we come over to TrendSpider, we can see that we have solar this morning. Finally getting a little bit of a bounce down here on the daily, but look, that's that's been solar, right? So I wouldn't get too excited about one little bounce in solar, because that's a really ugly chart. I mean, that's like change your own flat tire ugly, right? So we got building materials up more than 0.5% this morning too, and healthcare is right behind it. So just a little more out of healthcare, a little more out of crude, and it'll be at our benchmark of 0.5%. So we do have some things moving it to the upside. We almost always, right? No matter how bad things are, there's usually something moving up that you can find. It's just whether or not it's moving up enough to meet your qualifications. Yesterday, we had a really good market breadth until the open, and it was really nasty. Surprised. There was a Bloomberg article that had come out talking about how positive the breadth was, and I didn't catch all the numbers, but they compared it to the consistent day-to-day close with X amount of stocks, closing above whatever it was, the 20-day, the 50-day, hadn't been that good since 2000. So if I can find the article or find what they quoted, I will put it in the chat. But what it comes down to is that the collection of the 7 names carrying the whole market, well, it's spreading out. But it's going to take time for that to happen. It's not going to be done in one day. So yesterday, it was all the Mag 7. It was all the Boss Tech and software and Mag 7 names that were doing all the work. Market breadth was just trash. Today, the names that you would not want to see if you're expecting the S&P and the NASDAQ to rally, that's what we have up this morning. You don't want a NASDAQ rally on building materials and healthcare, right? And solar. You don't want an S&P rally on that either. So this is cumulative tick. That's what it looked like all day yesterday. Now think about the S&P and the NASDAQ and the moves to the upside while this was just bleeding off all day. This was the NASDAQ advancing minus declining issues. And there's the zero line. So it was positive through the day. Well, here's the S&P advancing minus the declining issues for yesterday. And there's the zero line. And it was red all day. This is really nasty stuff. Then you had the NY Fang group, basically your Mag 7. It always will start with a move up or move down. So, if you're trying to chart it, just ignore the first pop and then just look at what it did since then. So it was sideways for a little bit and then it grind higher. All right. Well, kind of reminiscent of S&P and NASDAQ yesterday, at least until around noon. Then it started to sell off. But finance was under VWAP and dragging to the downside, broke the previous day's low. So we had an inside day breakout to the downside and stayed under VWAP until well after 1 o'clock. So it was really divergent, really nasty stuff yesterday. If you look at the move that we made yesterday, from the time that we opened in Globex to that entire move, it sure didn't look like what we were seeing in the C tick or anything like that. Then just looking at the regular tick from yesterday, it stayed red through most of the day. So while the S&P was running to the upside here right after 9 o'clock and ran up all the way till noon, we were in the red here, and the weighted AD couldn't even get through 100. At this point today, We've got really big stuff on the table. It's got a lot of people nervous, and we're going to get job numbers, and that's been a big focus lately. So remember the range, and to narrow it down, since yesterday was a wide range day, start with your own Globex. It's what we have this morning. It's the most immediate thing closest to us. That's your first range. After that, deal with the regular trading hours of yesterday. That's your second range. And then finally, the third range would be all of yesterday, from the highest point to the lowest point. So from our own Globex range, if we break down, we've only got one more level to deal with. If we break out of our Globex range, then we've got one level to deal with up here. Short and sweet, nice and easy. Doesn't matter which way we go, right? You got structure either way. Look for things to broaden out. We need software, we need Mag 7, technology, chips, communications, or breakouts won't work, right? It won't matter if the other 490 names are bullish or bearish. If the Mag 7 isn't moving, then we can grind higher or lower. If the Mag 7 is bullish, we're going up. It won't matter what the other 490 do. And if the Mag 7 is bearish, we're going down. It won't matter what the other 490 do. Watch the clock. Be careful. I'll see y'all tomorrow.